And there you have it, the closing bell at the New York Stock Exchange indicating the close of the trading day. And what a day it was, not in a good way. The Dow plunging more than 1,000 points the day after the Fed announced its interest rate hike.
Yeah, the NASDAQ took a massive hit, down more than 5%, and the S&P is off more than 3%.
Joining us now is the head of iShares Investment Strategy Americas at Blackrock, Gargi Chaudhuri. Gargi, welcome. It's so great to have you with us. Can you explain why the market seemed to react favorably yesterday to the news that the Fed was raising interest rates, and then today seems to have the reverse reaction?
Sure. Thank you for having me. Interesting day to be here for sure. So yesterday, I think immediately after the release that we heard from the Fed, the market focused on the fact that they would not raise rates 75 basis points. The Fed came out and told us that that was off the table. And they really prescribed a path for the next couple of meetings, so call that 2 meetings. I think today, as we're all sitting back and thinking about what we actually heard from the Fed, we digested the news a little bit. Honestly, they are restricting monetary policy. They are telling us that they are going to raise rates by 50 basis points 2 more times, and then probably even more so. And in addition to that, they're going to be buying less bonds. So they announced something called quantitative tightening, which reflects what they're going to do with the bonds that they have been buying in the secondary market. So all of that does lead us to believe that we're entering into this period where we will have more volatility in the markets, because we've gotten used to this regime of the central bank buying bonds, keeping rates low, and now we're stepping out of that into a regime where rates are going to move higher. And they're not only not buying bonds, but actually actively shrinking the size of their balance sheet.
Should we come to expect a certain level of volatility as the Fed works to get inflation in check as they take these measures?
I think that we can probably see some more volatile periods, such as today. I don't think it's going to happen every day. We're not going to see these 3-5% moves every day. But yes, as we get out of a period of monetary policy easing into a period where monetary policy is slowly becoming more restrictive, I think we can expect to see some more volatility. And that's why, when we talk to our clients, when we speak to investors, we tell them that you really have to think about the broader picture, the bigger picture. What is happening to the U.S. economy? Is it still a strong, robust economy? And the answer is, at least for the U.S., yes.
So when we talk about the Dow losing 1,000 points, people immediately want to know which sectors, which industries were hit the hardest. And then how will that affect me, right? How will all of this affect the average American?
Yeah, so look, the big thing that the Dow and the S&P and the NASDAQ are responding to is the level of interest rates. Interest rates are moving away from, or have moved away from 0. They're at 1%, and the market's forecasting that it's going to get to above 3%. Now, an investor, a person that's investing their money, obviously will pay a higher cost to borrow. So that's the first thing. So if you're looking at student loans, if you're looking at auto loans, if you're looking at mortgages, your price to borrow is going to go up. And eventually, that's not yet because wages are going up, and we'll learn more about that tomorrow. But eventually, is it going to get so high that that constrains our ability to spend? So that's something that we should all be thinking about. And the second, to your point, with those higher rates, what parts of the economy slow down? Where should we expect to see opportunities? And where should we sort of stay away from because there's going to be more pain there or more volatile periods such as we had today? And another point that I want to make is around the bond markets, right? So obviously higher interest rates means lower prices on bonds. Historically, when equity markets have gone down, your bond side of your portfolio has worked for you.
Right.
Recently, in fact, this was the first time ever that if you looked at, actually even up until today, bond prices and stock prices are down in double digits. That hasn't happened since we've had the history of bond prices, like since the 1970s.
So investors don't know where to put their money.
So that's why, again, thinking about the long term, sort of being more focused on what the U.S. is doing versus other countries, investing for the long term, and really what we call looking at sort of quality companies, companies that have the ability to absorb higher prices. We think that makes a lot of sense. The other thing I would say is also having some stocks, having some bonds, adding some commodities as well, because that's a story that's going to sort of the higher prices for commodities, that's going to be with us for some time. So really diversifying and playing the long game.
And are you feeling a little bearish on tech stocks right now?
Some portions of tech, yes, but I would say for the most part, the quality parts of tech, and tech actually happens to be a sector that has very good pricing power. So many companies, and we saw this during earnings seasons, have the ability to pass on higher prices. We will pay more for a certain type of iPhone, for example. So I would say that, certain areas of tech, a little bit more bearish if interest rates keep moving up, but actually quality technology companies this is a good opportunity to get your hands on some of that.
All right. It's been an interesting week. Thanks for breaking it down for us. Gargi Chaudhuri, thank you.
Thank you.